Hello and welcome to Finextra. I'm Hannah Wallace and today I'm kindly joined by John Mason from Thomson Reuters. We're going to be talking about MiFID II. John, thank you for taking the time to speak with us today.
Good to be here.
With RTS 27 and 28, best execution obligations of MiFID II coming into force, can you tell us a bit about what each of these require and the timelines associated?
Sure. Well, the RTSs, or the regulatory technical standards, if you like, underpin how MiFID has been implemented. RTS 27 is really towards the execution venues, so it's towards the likes of the systematic internalisers, the MTFs, the OTFs, although some reports in the press at the moment, not all the OTFs think it applies to them, market makers and other liquidity providers. And it's approximately 9 or so tables of information that covers speed, costs, likelihood and price of execution that the venues have to display. And that's a quarterly report. It's due as of April this year, so Q2 will be reporting on Q1 and companies have until the 30th of June to report. RTS 28 is therefore geared towards the investment firms. That's an annual report as opposed to a quarterly report, and that covers about 3 tables of information, and that's really looking into the transparency of how those organisations have executed on behalf of their clients. It covers the top 5 venues as well as some of the other price and cost information. So both best execution reports are starting to now sort of come into view, if you like. They're no longer on the horizon. Some are very sort of short term in terms of RTS 27 and organisations are starting to turn their attention to producing those, having moved out of the immediate requirement of trade and transaction reporting, starting to look at the best execution requirements.
And what do you see are the challenges firms are facing when trying to satisfy the best execution requirement, and will they have all the data they need for the first report submission?
Well, data is critical. A lot of people have already said that MiFID really is a data exercise. If you're going to look at internal information, that's a matter of making sure you're collecting all that information so you can meet some of the requirements that are needed with regards to particularly RTS 27 in terms of mean execution time and so on. That's a lot of granular data that organisations need to collect. The investment firms RTS 28, that's about understanding where you stand in relative terms, i.e. what are your top 5 venues, have you got that information? But also what we shouldn't lose sight of is there's best execution monitoring. So it's not just a matter of producing a tax return once a year or once a quarter, it's not an equivalent of that. Organisations have to demonstrate a continual aptitude, if you like, towards supplying best execution to their clients. And that means having an ongoing view of the execution they're receiving in the marketplace. And that then takes them into further challenges as to have they got the systems that are appropriate to take that, and have they got the data that actually supports that underlying information.
And what consequences in the market do you foresee as a result of best execution, and does this bring opportunities to your clients?
Well, ideally it meets the requirements, and by that I mean the consequences should hopefully be better investor protection, better sustainability and of the integrity of price formation, and better choice. Those were the things that best execution was there to drive. I think what we are seeing though is we are beginning to see organisations look to how they can address the capital, i.e. the best execution that they can offer, where can they get that best price formation, is it against their central risk book, is it out in the marketplace. We're beginning to see some discrepancies between the prices and the ticks that systematic internalisers can offer or equivalent venues such as Switzerland can offer versus what European venues can offer. So there's already some talk in the marketplace as to whether there'll be a MiFID III already, only 2 months in, and whether that means there'll be more harmonisation of tick sizes across SIs, across equivalent exchanges, as well as the European exchanges. Otherwise, I think on best execution, you're looking at will we get the large getting larger and the small having to go niche in order to compete, because I think there will be a gravity pull towards the larger organisations who offer the best access to price formation, offer the most diverse liquidity to clients, and that may mean that those that can invest in their systems, offer great analytics, use transaction cost analysis to their benefit, may be the winners as a consequence of best execution.
Finally, post-MiFID II implementation, what are you seeing as the impact on non-financial institutions?
Well, non-financials, I think, is an interesting dynamic, really. We've had multiple areas. We've had things such as the legal entity identifier. So can they even get into the marketplace in the first place to get best execution? So I think that is something that we're still, or the system is still working through with the 6-month sort of furlough that ESMA put out there at the beginning of the year. So I think corporates should be receiving and can expect to receive better execution in the marketplace. They may see a consolidation of the brokers that they would go to. That sort of barbell effect that I touched on, where at one end of the market you have those that can provide that capital and provide that better analytics, offering greater service at one end and niche providers at the other. So it may depend as to what the corporate is looking for in the marketplace, as to whether it sees its marketplace going down that sort of barbell route and having to determine who it wants to trade with. And also from a listing perspective, if we do see liquidity flows going out to external venues, such as Switzerland, as a consequence of tick size, and those don't get harmonised, then corporates, if they're listing corporate bonds or something like that, may decide that they want to actually trade or list across a multitude of venues, not just on a single venue, so that they can offer a different choice to people who might invest in those bonds. So I think it's still early, 2 months into MiFID II, to draw any real sort of analysis. We're still guessing in some respects as we look into the future. But I think you're beginning to see some movement towards certain areas, and over the course of time we'll see whether those turn into trends. And therefore I think the corporates will keep a watching eye on what's happening in the marketplace to see whether it's going to affect who they deal with as and when they step into the markets.
John, this has been great. Thank you very much.
Pleasure. Thanks again.
And thank you for watching.